What's up, everybody? My name is Mike, and I want you to be successful in the stock market. Financial education is so important. It allows us to do the things that we ultimately want to do. It's about financial freedom. It's about spending more time with your loved ones, spending more time with your family, spending more time with friends. It's really about time. We're all here for just a small amount of time in the grand scheme of things. What are we doing here? Financial education allows us to figure it out and be able to spend more time doing the things that we actually want to be doing. In 2017, we were able to triple the return of the S&P 500. That wasn't easy. And over the past however many videos, we have walked you through every single trade that we took in 2017. Of all the lessons, I've drilled it down into the top 10 lessons that I think that you should know. Lesson number 1, modeling success helps a lot, especially when you are trying a new strategy and it's new. With trading, so often we look to pick up a book, start applying what's in the book, and then that's it. And most of the time we either get it right away, for those of us that are very fortunate, or we start to get it, we start to stumble, but we persevere, and that love gets us through. What happens to the vast majority of people, we try to apply it and doesn't work, and we give up, and that's it. And trading is rigged, and it's not for me, and anybody that tries to tell you otherwise is full of it. What modeling success does is it allows us to learn and get that training step by step and being held by somebody that's already achieved success. So for me personally, I am more of a swing trader, and my partner Adam Sarhan is more of a intermediate term trader. He does all different kinds of tradings, but he specializes in the intermediate term. And so that was something that for years I struggled with. I would get scared, I would end up selling too early, I would blow out of positions, I would see something happening in the overall market, and I think that I need to sell my overall a lot of positions in my portfolio, and I took losses for years and years, and my equity curve kind of looked like this, where it was just chopping around sideways, boom and bust, boom and bust. What finally got me over that, it wasn't just having a trading log and trying to learn for myself, although that is essential, that's part of it. And it wasn't just reading books, and it wasn't just watching videos either. It was modeling success. Trade for trade for trade, and watching how he would do it, trade for trade for trade, and being able to ask him questions all along the way. Eventually, towards the end of 2017, I was able to start to understand, okay, so Adobe is pulling back, but we're still going to hold through it, even though it is testing that 50-day moving average, even though it's now trading a little bit below that 50-day moving average. And why? Well, we're sitting on this huge gain. And how is that different from another stock that we had just gotten into? Why aren't we giving it that much room? It's being able to find and model success and be able to see what success looks like through the eyes of somebody that's already done it, that helps us get to the quote-unquote promised land. And I think that might even be a little bit strong. I think that learning is a continuous process, but being able to model success helps us jump towards the end of that learning curve. It's not like we need to have that slow and steady climb up. We're able to see what somebody that's already successful is doing, being able to model that success, being able to ask questions along the way, and then gain a much deeper understanding of what's going on and why, and trusting the process. Lesson number 2, create and follow simple time-tested rules. Now, if you've seen my blog, you have seen this long laundry list of buy rules and sell rules, and that's how I started out. I outlined everything that was in this book, How to Make Money in Stocks by William O'Neill. This is a fantastic book. I highly recommend that you check it out if you haven't done so already. There are so many different rules and strategies, and what we need to do is to be able to find something that's going to work for us, and once we do, simplify it so that way it's something that we're able to do automatically and it becomes something that's automatic. If we have a long list of 50 to 100 different rules that we're trying to execute on at every single time and we're new, that it's just a recipe for disaster. So what we want to do is we want to get good, and we want to get good at a handful of things at a time. The simpler we're able to keep things, the easier it's going to be for us to follow those rules and be able to execute on them. After we start to gain more and more and more experience, then we can add a little bit more complexity or tweak things in a very subtle way. Too often, we want to try to make something as perfect as it possibly can be. In fact, well, we have real money on the line, right? So we don't want to lose out. We want our trades to be perfect. We don't want to lose. But we also need to understand that losing is part of the game. And actually, the more that we try not to lose by building in additional complexities into the system, then we end up losing more because we're using a much more complicated system, and oh well, it's the system that's complicated, and I'm the practitioner of this system, and it's not the system's fault, it's my fault because I don't understand the system properly. Well, it is your fault because you created a system that is way too complicated. Keep things as simple as you can. One of the simple rules that we came up with throughout this path to tripling the S&P 500, and Adam talks about this all the time, is a simple 3-strike rule. So the 3-strike rule it's all based on technicals, and we are looking to exit a longer-term trade or an intermediate term trade that ends up being long-term because the trade is just continuing to run, kind of like Adobe, is to exit when the stock breaks an uptrend line, breaks down below the 50-day moving average, and also breaks below an important level of support. So once you have all 3 of those boxes checked, that's the 3 strikes. When you have 3 strikes, then you're out. That's it. Pretty simple, but actually sitting there and seeing it happen in real time, you realize that there will be situations where you could end up giving back 15%, 20%, possibly even a little bit more than that. And are you going to be okay giving back that much? And if you're not, is this the right strategy for you? And how can you tweak the strategy to fit what your mindset is? Or how can you review this and adopt a new mindset? A lot to think about. Lesson number 3 is be consistent. So every single week when we were doing this exercise, you noticed that it was consistent every single week. Every single weekend we reviewed the market. Every single weekend we had a plan. What we didn't necessarily do every single week was move our stops or have something to buy for the next week. Those are things that the market would tell us to do. It tells us that through market health, the overall health of the market. Are we in an uptrend? Are we chopping around sideways? What are the stocks in our portfolio doing? Are they running? Are they pulling back? Are we having big gains? Are our stop losses starting to hit? All these things give us a flavor of what we should or shouldn't be doing. It's not constantly taking action, but it's the consistency of reviewing the market, of reviewing our portfolios, of looking for trades and then deciding, should we execute more trades? Should we stay with what we've got? Should we pull back a little bit more? Should we step on the gas? It's doing those things consistently and then figuring out What does consistency mean to us? Well, what are we capable of doing in the market? Are we capable of being somebody that's a lot more active? Do we want to be more of a swing trader? Do we want to be more of a day trader? Are we more comfortable in that intermediate term where we don't have to look at the market every single day, where we are able to review our trades and our portfolio in the market really once a week and checking in maybe twice a week to see what's going on with the market, how is our portfolio doing? That's the key. That's the real key. The real key there is consistency. If we were just checking in once a week and then we took a week off and then we checked in next week, or we took a month off and then we're checking back, or we started to check every single day and then we were checking a week later, that doesn't work. Part of why it doesn't work, even when we feel as though we have more time to do more, it can start to build a little bit of a bad habit, because we can find that we want to execute more, we want to do more research, and then we want to take on more trades. But if it's not something that we're able to sustain consistently, we can quickly get into trouble. Think that it's important to figure out what we're able to do consistency given our lifestyle, and then stick to that. And we could do more research, we could do more education, but then to take it to that next level where we want to execute more consistently, then we really need to review our schedules, review what it is that we're trying to accomplish, and then come up with a full plan of how we're going to do that over a longer period of time, and where we're not just trying to execute just for this week, but we're trying to execute over the course of the year. Tip number 4 is understanding the overall health of the market. Now, this is going to come in a lot of different flavors. So flavor number 1 is understanding what's going on in the news and what sorts of things are affecting the market as a whole. What we perceive is affecting the market, it's going to be different for you, it's going to be different for me, it's going to be different for Adam. What really matters, what really matters to me, is more about the price and volume action of the indexes, because it's like the collective decision of everything that's going on. So you're seeing the market your way, I'm seeing the market my way, Adam's seeing it his way, Joe down the street is seeing it his way, Sally down the street is seeing it her way, and everybody is participating, and it's all that buying and selling that is creating the price and volume movements of the market. All that we're seeing on the chart, that's really everybody's decision of what's going on. If we're able to interpret that, identify trends, see where things start to get wide and loose, or see where things start to tighten up, and see it not just on one index, but to see it across indexes, it starts to tell a story. And from that story, we're able to glean not just what the talking heads on TV are saying, but what the collective is actually thinking. That is where a lot of this technical analysis comes from. That's what Adam talks about. That's what I believe. And it's one of those things that really helps us out quite a bit. So that's the market, the major indexes. But what's also going to be important to all of us is going to be, what are the stocks that we're interested in actually doing? So the ones that we're interested in trading, the ones that I'm interested in trading, are going to be the stocks that are leading the market higher. And I'm also going to be interested in stocks that are quote-unquote growth stocks, because those are the ones that have historically proven to go on to make these gigantic gains. The reason why I'm interested in those, or the reason why those are important, are because those are the ones that I'm going to be focusing on. I'm not interested in what GE is doing, and I'm not interested in what General Motors is doing, because those aren't the kinds of stocks that interest me. They're not leading stocks. Those are more of the value plays that have kind of been around forever. I'm interested in the new and upcoming stocks, the ones that are able to go on right now and make gigantic moves. We need to understand the stocks that are in our universe, the stocks that we're focusing on, and then how are those stocks behaving. It helps us to focus on the stocks that we're interested in because it helps us filter out the noise. And when we filter out the noise, we're able to focus and we're able to have a lot more clarity and have a lot more success in the market. Lesson number 5, one account, one strategy. This is something that took me years to finally really have a firm grasp of and understand. So when I was starting out, I would try to do everything in one account. I would try to trade on that intermediate term where I'm going for those huge wins. And then within that same account, I'm trying to do some swing trading. I'm trying to test new ideas. I even try to day trade all within this one account. So I have all these different strategies, all these different kinds of trades all going on at the same time. And that just doesn't work. And part of the reason why it doesn't work is because, well, for starters, you have way too much going on. Second, when one thing starts to not work out and you want to go and test out a different idea, well, now you need to sell one of these trades to go finance another trade. And you may end up selling a trade that hasn't quite done anything wrong yet, but it's still kind of setting up on that longer term. It's still playing out that thesis, but this shiny new idea just came out and you're feeling more strongly. So you kick that other one to the curb, you go for the shiny one, and inevitably what happens is your original idea ends up taking off and this shiny new object turned out to be a dud. Happened to me time and time again. And part of it was because I was trying to do too much in this one account. The other part of trying to do everything in one account is when we do go back and we review our account and all of our trades, it's so hard to figure out what worked and what didn't, what was driving our account up and what was pulling it down. Having one strategy for one account eliminates all that. What it does is it allows us to just focus on this one strategy, see how it's working and see how it's working over time, and it allows us to have so much more clarity both in the account, in our minds, in our plans, and allows us to win so much easier over the long run. Had I had multiple strategies going on in my trading account, I would not have been able to triple the return of the S&P 500 in this one account. What allowed me to do it was just, again, following along with that model portfolio that Adam put out, trade for trade, as we spoke about in this whole series. And by doing that, I was able to triple the S&P. If I was trying to do option strategies and day trading strategies and testing out different things, I may not have had the capital available to take every single trade and follow along with the process. Sometimes I may have felt that, hey, it was great that I didn't have the capital because look at that one trade. That one trade turned out to be a loser. Well, I may have missed out on one of the bigger trades like an Adobe or like an Intuitive Surgical or like an Alibaba, and that would have ended up killing the return of that particular account because those are the trades that ended up going 60, 70, 100% or better. We need to focus. We need clarity. And the best way to do that for our trading is to have one account and one strategy per account. Number 6, position sizing is hugely important to our success in the market. If we have a position size that is too small, then a big win's not going to matter. But if we have too big of a position, and we have a loss, then couldn't end up killing our year. What matters is that we have a consistent way of managing our position size. So what I personally like to do, and it's pretty simple, there's a lot of videos that I've already done on it, but just to mention it briefly here, is I like to risk 1% of my trading capital on every single trade. So that doesn't mean that on a $100,000 portfolio that I'm only buying $1,000 worth of a position. What it means is that I would be risking $1,000 worth of a position. The way that I figure out how many shares I can buy is I will figure out where I'm going to enter, where I'm going to exit, and then back into the number of shares that I could buy, and while still risking just that 1% of capital. So if I find a trade where a stock is trading at $100 and I buy it and I plan on exiting if it falls below 98, I'll be able to buy a lot more shares than if I bought that same stock at 100, but if it fell to 90, I would look to exit. The key is what we're going to risk, what our position size is ultimately going to be, and being consistent about what we're going to risk. Again, that 1% is pretty standard. There's a lot of different ways to position size, but stick to the 1%, especially if you're somebody that's new. I think that'll help you out a lot. Tip number 7, we've got to persevere. It's the only way. It's one of those things that after looking at all the trades of 2017, you could really see that there were more than a few dry spells, quite a few losing trades in a row. And if we just gave up, if we didn't persevere, then it would have been impossible to have those big gains. It would have been impossible to have a 65% return on the year. It would have been tough to sit through a lot of those drawdowns too. So when we're sitting on a big winner, like an Adobe, and it starts to pull back, sitting through and watching that is real tough. In real time, it's real tough, and we need to be able to persevere. We need to be able to trust in our rules, in our plans, in what we laid out, that the system actually works, and that not allow it to do its thing. If we don't, if we try to hijack the system, if we try to squeak out just a little bit more, it does a few different things. We may win in that one instance. It may end up being the right idea, but over the longer term, we're building bad habits. It's not going to pay off in the long run to start breaking our habits, having inconsistencies, not following our plans, not following through. We need to persevere with strategies that work. And part of the way that we know that they work is through testing and through journaling, and by consistently auditing our process. And and the auditing of the process, that'll look different to everyone. For me, I audit my process quarterly, and I will review my trades in my portfolio every single week. I think that we need to believe in ourselves, and part of believing in ourselves allows us to persevere when the time gets tough. Belief in the systems that we are doing allows us to persevere, but it is belief in ourselves, because if we believe the system works and we start to doubt ourselves, then it's real easy to fall off the wagon and start to try to tweak different things. When we are modeling success and we're modeling a track record of success, it's a lot easier to follow along and trust the process, because we're not trying to trust ourselves as somebody that's trying to implement a new strategy, or somebody that's completely new to trading. We're following along a path with somebody that already knows what they're doing, and we're able to sit and learn and understand that there are going to be these bumps along the way, and it's up to us to climb over those hurdles. And we don't need to do it alone. We're able to do it as a group, and groups tend to do a lot better than the lone wolf. Lesson number 8. Understanding charts is important. There's no way around it. We need to understand what all those little lines on the chart mean, how to interpret them, how to identify trends, how to identify consolidations. And it does take time to understand and have a grasp of these things, and there will be uncertainty of, is this right? Where is support? What should I be doing? That's part of where modeling success comes in. It's part of where putting in the hours and learning this stuff comes in. But part of what understanding charts allows us to do, it allows us to identify trends on different time frames. So on a weekly time frame, looking at weekly bars, is the stock or index or whatever it is it moving up? Is it moving down? Is it moving sideways? What do all these moving averages mean, and how can we interpret those? Where are the various support levels? So if the stock or index or whatever drops below or comes down and hits a certain level, are there likely to be buyers that will step in, and why? Why is this a prior support level? Is there a ceiling or a resistance level that price may hit and start to pull back in? And why? And understanding that and being able to see that on the chart. It's something that we need to train our eyes to be able to do, but again, it's something that you don't necessarily need to do alone. There's a lot of great information out there. There's a lot of great videos out there on this channel, on other people's channels. There's a lot of great books out there too. Read them, understand that you don't need necessarily every single type of strategy. There's a lot out there. There's basic price and volume action, there's candlestick charts, there's Renko charts, there's all different kinds of charts and stochastics and MACDs, and let's see, what other things can I throw out there? There's Fibonacci, retracements, and all these weird kinds of things that you haven't even listened to on this channel yet, and you don't need to know all that stuff. What you need to do is have a basic understanding of really the just price and volume, and that's it. The simpler that we're able to keep things, the better. And the more indicators that we start throwing into the mix, while it may seem like we're getting more and more precise, all we're really doing is creating a lot more noise. Being simple is what has helped me over the long term. It's what's helped Adam over the long term. It's what helped William O'Neill over the long term, Nicholas Darvis, and so many others that are just really identifying price and volume. And if you're somebody that does enjoy a lot of these other indicators, then more power to you. For those of us that are just starting out, I would definitely say keep it simple. Go with the basics first. Lesson number 9. You've got to love the process. If you don't love the process, you're going to quit Why else would you allow the market to continuously kick you in the face every single time when you're learning, when you think that you're doing everything right, when you think that you're modeling success, and then you need to sit and wait for a solid 5 months before you see another winning trade? If you don't love the process, you're gonna quit. You're going to move on to something else. You're going to test other things. You're going to give up, maybe on trading altogether. So there's a lot of ways to make money in the world. There's a lot of ways to be financially free. You need to figure out what's going to be the best for you. If it's trading, fantastic. We've got a lot of great information here, and there's a lot of great information in the world on how to do it. If you find out that it's not for you, then maybe you should quit. Maybe if you don't love trading, if you don't love the process, if you don't love the losses, if you don't love getting kicked by the market, then you're going to end up losing over the long term. It's not about, I had a losing trade, that's great, and yippee, I'm jumping out of my seat. It's loving the whole thing in its entirety. You can't have reward without risk. You can't have wins without losses. You need to be able to go through the grind of doing it. You need to be able to love the education of doing it. You need to love the hard work of doing it. It's that love that's going to pull you through to the other side. If you don't love it, you won't survive. And finally, big lesson number 10 is do not hesitate. One of the reasons why we come up with a plan on the weekend is because we want to outline exactly where we're going to get in, where we're going to get out, how much we're going to risk, and be able to enter those orders on the weekend, or maybe we enter them on Monday morning before the market opens, and we place those orders, and then we're able to walk away. We place them as buy stops, so once the price is triggered, it gets executed immediately. We're not hesitating. Same thing on the selling side. We place our stop losses, and that's both for the initial stop loss, and as the trade progresses, we raise those stop losses, and we're setting those at night or on the weekend or before the market opens. We're not going in and placing them as an alert is going off. It allows us to not hesitate. Once something triggers, we're acting immediately and decisively, and that's it. If we hesitate, we die. Right? Think about it. If we are a deer caught in the headlights and we do not act, that's it. We're done. We need to act. And the way that I've learned to act and the way that Adam has learned to act is by placing buy stop orders when we're buying, to place sell stops when we're selling, and so that way, once price hits that level, the trade is executed immediately and there's nothing else to do. It's one of those things too that lets us not have to look at the market all day long. It allows us to place our orders, do that homework, and then be able to go and do other things during the rest of the day. It's one of those things that allows me to be able to take advantage of the market and still be able to have a separate full-time job, be able to have a family, be able to go out and spend time with friends. Because I'm not sitting here worried about the market and worried about having to execute an order either on the computer, on my phone, or wherever else. It's already there with the broker, the plans are made, and they are all going to be executed without hesitation. If you're somebody that likes to sit in front of the computer all day and you like to use what some people call mental stops, then more power to you. But the key thing is that we execute without hesitation. Hesitation is what kills us. So the trick that I like to use is to have it be automated. So that way I'm not relying on myself, because I know that if push comes to shove, if something happens, if an alert goes off, I'm going to look, I'll try to analyze why the stock moved this way, if it moved suddenly, well, what's going on, are there other opportunities, and then all the while, the price could be moving against me more and more and more, and I'm trying to figure out why, and when I could have exited up here, now I end up exiting down here. Why? Because I hesitated, because I was trying to figure out what was going on and why and everything. What's more important is laying out the plan beforehand and then executing on that plan. Same thing on the buying side too. We see the price consolidating, we analyze the chart, we know where resistance is and where price is going to break out, so we place our buy stop right there. If we don't have that buy stop in, if we just have an alert set in and let's say it gaps up, then we are sitting there trying to figure out, oh, when should I get in? What should I do? How should my strategy change? Well, if you're able to still execute without hesitation, fantastic. For me, I would much rather not be tied to my desk or be tied to an alert or feel the need to, I get an alert and then all of a sudden I have to check the market. Let the plan execute and execute without hesitation, and that's one of the things that's allowed me to succeed in the market and one of the things that allowed me to triple the return of the S&P 500 in 2017. So those were the 10 biggest lessons that I learned from my trading journey in 2017 that ultimately led to me tripling the return of the S&P 500. I really, really hope that you enjoyed and got a lot out of this series. I got so much out of just making the series for you. It almost feels as though I'm the one that's getting the most value out of this, because man, oh man, going back and looking through all those trades was really, really eye-opening. Thank you so much for being a part of this journey. If there was anything that you feel that should have been included in these rules that wasn't, like if you would have added a rule number 15, rule number 20, leave that down in the comment section below. I think that it would be real helpful, both for anybody watching, for myself, and also helpful for you too. When we write things down, they tend to stick a lot more. If you like this video, click that thumbs up button. That's going to help us out a lot. Make sure that you subscribe to the channel so that we get every single update. Thanks again for watching. Really appreciate it. I appreciate you guys, and I'll see you again in the next video. Take care, and have a great day.